Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to our Blue Hour webinar number 3 titled Stock Investing for Students and Those Not Near Retirement. Now, earlier this year, we incorporated a series of webinars, which we call the Blue Hour webinar, and we plan to host 6 of these every calendar year. And these presentations are free to our premium members and available also to general members. Tonight's presentation is a little bit different than the presentations that you're used to me doing over the past 10 years we've been working together. So in that regard, we're not going to be doing short-term option investing to generate monthly cash flow, which is basically what we've been doing together for the last decade. Instead, we're going to do a longer-term investment plan that's geared to students and anybody not near retirement. Now, I realize that many of our members are actually near retirement or in retirement, and this particular strategy that I developed is not for you. However, it is definitely for family members, children, grandchildren, and if you could take this information and share it with them and give them an opportunity to build up a significant financial empire over the next few decades, you've done them a great service. Now, Barry Bergman, our Director of Research, is available during this webinar to answer your written questions. So look for the chat box either at the top or bottom of your screen. Click on Barry's name, type in your question, and he'll share the answer with the entire room. You could see on this screenshot here where the red arrows are, where the chat links are, and then once you see that, you'll click on Barry's name and type in your question. And Barry's pretty good at responding to just about all of the questions. I want to say a special welcome to the financial literacy students from Syosset High School. They invited me to speak at their program a few months ago. It's run by Tom Barella and Marianne Conchesi, and they do an unbelievable, outstanding job of teaching high school students financial literacy. And my hope is that programs like this will be developed by other high schools throughout the country. So welcome. Here is our strategy overview. We want to set up a user-friendly investment plan that will achieve financial security and an early retirement. Now, I'm going to be presenting to you a strategy that's in my book, and this webinar is based on my book, Stock Investing for Students, and it's a 40-year plan. However, this can be adjusted. You know, if you're 30 years from retirement, 20 years from retirement, you can adjust it accordingly, and I'll show you how to do that. But we have to start with a hypothetical, and the hypothetical is you're 18 years old, you're graduating high school, and you want to start investing for the future because retirement comes upon you much quicker than you can ever believe. Now, the information that I'm presenting in this strategy is based on proven and sound financial principles. There's no monkey business here. We're going to talk about financial principles such as compounding your profits. That's where you take the interest that's known as. We're going to talk about dollar cost averaging, where you put an equal amount of cash into your investment account in equal time frames, and I'll show you how to break that down. We're going to talk about things like dividend reinvestment, own a security that generates a dividend, and rather than taking that as a check or cash, you immediately reinvest those dividends to purchase additional securities. So these are sound and proven financial principles, and that's what we're going to be concentrating on throughout the course of this presentation. Let's take a look at compounding, for example, because this is such an important factor in your financial security over the long term. And we're going to start with a hypothetical. I know it's a large number, but it's going to help me make my point of $100,000. And we're going to assume an 8% annualized return, which is the low end of the historical returns of the stock market. Most people say 8 to 10%. We're going to use 8%. Now, there's a rule, a mathematical rule known as the rule of 72. And the rule of 72 says the following. If you take the annualized return that you generate and divide it into the number 72, that resulting figure will tell you how long it will take to double your money. So in this particular hypothetical, our 8% annualized return divided into 72 means that it will take 9 years to double our money. So $100,000 becomes $200,000. That's the power of compounding. Now let's assume for a moment we didn't reinvest our profits. That means we would be making 8% profit on $100,000. That's $8,000 a year times 9 years. That results in a profit of $72,000. So the difference is very dramatic. The difference is $28,000 by compounding, of utmost importance when you're looking to invest for your future in terms of an early retirement and investing with a nice nest egg, that we must incorporate compound. Next, let's talk about dollar cost averaging. This is also a very, very important financial principle. Now, the amount of money that I'm going to suggest we invest in this long-term plan is 10% of our gross annual income. So let's say, for example, we're earning $60,000 a year. That means we would take $6,000 and allocate it to our investment plan. Now, $6,000 is not put into your account at one time. What we want to do is spread it out over the course of a year. So what we're going to do is we're going to take 1/12 of 10% of our gross annual income and invest it incrementally at the same time every month in the amount of $500. That's 1/12 of $6,000. So each month we're going to instruct our broker to take $500 from our checking account and purchase shares of the particular security that we're investing with. We'll get to that in just a moment. Now, when should we invest that $500? It could be the 1st, the 15th, the 30th, whatever's a good time of the month. If you get paid at a certain time, it should be sometime after that. You are in charge. You tell your broker when you want that money taken from your checking account, put into your investment account, and purchase the shares the way you instruct your broker to do. So that is known as dollar cost averaging. The advantage of dollar cost averaging is that when share price goes down, you're buying more shares. The stock, if you're investing $100 a month and the stock price is $20, you're going to buy 5 shares. If the price goes up to $25, you're going to buy 4 shares. If it goes down to $10, you're going to buy 10 shares. So in the long run, you're going to end up purchasing more shares at a lower price. And that's the advantage of dollar cost averaging. So we're not going to take the entire 10% and invest it at one point. We're going to spread it out over the course of a year. Let's talk about dividend reinvestment. Many securities, whether they're stocks or exchange-traded funds or mutual funds, generate dividends. And particularly blue chip companies tend to generate dividends. And these dividends can be taken in the form of cash. My mom does that with her stocks and mutual funds, and she has those dividend checks sent to her on a regular basis. But for a long-term retirement account, for those not near retirement, it would be better to reinvest those dividends. So we instruct our broker to, when a dividend is distributed, to purchase additional shares. Some people refer this to DRIP, or the dividend reinvestment plan. And the dividends are generated on what's known as the pay date. So there are certain dates associated with dividends, like the ex-dividend date or the record date, but the pay date is the date that the dividend is distributed, and that goes right back into the purchase of shares, which can be purchased incrementally. So that means that you could buy shares fractionally. For example, it may come out with the dividend amount that's distributed that you could buy 4.33 shares. And that can be done. So that's part of this dividend reinvestment plan, the fact that it can be done fractionally, and it's automated, just as is the investments that you make from your checking account into your investment account based on 1/12 of 10% of your gross annual income. Now, here are the basic assumptions that we're making, and these can be adjusted based on your particular situation. As I mentioned before, we're going to start you at the age of 18. You're graduating from high school. And we have a goal of retiring at the age of 58 with $1.8 million. And as you see me go through this plan, let me reiterate, there's no monkey business here. Now, we're going to start with $1,000. And why do I say 1,000? Because that's the amount of cash you need to have on hand in order to open most brokerage accounts. Now, if you're in school, where do you get the $1,000 from? Well, folks, that's your problem. You have to figure that out. It could be from a part-time job, or perhaps tell your family and friends when it's your birthday, instead of getting another video game, you want cash because you want to have the ability to open up a brokerage account once you reach that $1,000 threshold. As long as you're motivated to do it, you can do it. Now, as I said before, we're going to take 10% of our gross annual income each year. In this hypothetical, we're going to make the following assumption, folks. We're going to assume that for the first 20 years of this 40-year plan, you're going to average $60,000 gross annual income. That means you're going to take $6,000 and allocate it towards your investment plan. That means you have to get along with $54,000. That's just that you have to be structured enough to do that. In the hypothetical, the second 20 years of this plan, you're going to average $80,000. Now, most of you are going to be making more money than this. And if you have a partner or a spouse, you're going to have two incomes, and it should be way more than that. But we're going to just start out with basic assumption of 60 and 80, 20 years, and then the second 20 years. So for the first 20 years, where we're making the assumption that you're averaging 60,000, that comes to $500 a month. 10% is 6,000 divided by 12 is 500 a month. Now, the second 20 years, where we're considering 80,000 as a hypothetical, that's 8,000. 1/12 of that is $666 a month. Remember, it's completely automated. So you just instruct your broker to take that amount out of your money on this particular date, let's say the 15th of every month, to purchase shares of the underlying security. We're going to assume a return of 8% per year, which is the historical low for the stock market. And these are the assumptions that we're going to make. And once again, with the compound calculator that I'm going to show you, you can adjust that accordingly. Now, what I want you to do when you start this plan is I want you to write down your goal and keep it in view. I'm going to be making $1.8 million by age 58. Write it down, put it by your computer, make sure you look at it every day, and be motivated enough to follow through with this plan. That you have to set a goal in order to achieve a goal. Now, I'm going to show you how this calculates out by using a compound savings calculator. There are a lot of them that are available online, and the site that I used is bankrate.com. It's a free site, and you'll see the calculator in action in just a second. So here's what the calculator looks like. Let's break this down now based on everything that I just told you. We're going to start with $1,000. We need that amount of cash to open up our broker account. We're going to invest over the first 20 years of the plan $60,000. 10% of that is $6,000, which means that every month we're going to allocate $500 at a annual return of 8%. So you could see here that the line goes up from the $1,000 that we initially invested, and it ends up right here at $299,400. That's the amount of cash that will be of value in our investment account if we generate 8% a year by investing $500 a month, starting with $1,000. That's the hypothetical. And all that is based on historical data. Now, let's take that through the next 20 years. Now we're starting at year 21. Year 21, remember now, we're starting out with 299,400. That's our starting point, because that's what we ended up after the first 20 years. And we're going to do this for another 20 years at the same 8%. However, now the investment increases to $666 a month, because our hypothetical assumption is that we're going to average $80,000 a year over the last 20 years of this 40-year plan. And you could see here now that the amount of cash that we're going to have available at the end of the 40 years with compounding brings us to our goal of $1.8 million. So this is done with a compound calculator that we found on bankrate.com. Okay, let's move on now to how to get started here. And remember, we started out, we have to open a brokerage account. We'll discuss that in a moment. Most brokers want us to put $1,000 in to open up our account. Now, what kind of security are we going to use? We're going to start out with mutual funds. And the reason we're going to start out with mutual funds is because we want to be properly diversified. And to start out with stocks with $1,000, we just can't do that because we're not going to be able to diversify properly. So we're going to start out with mutual funds, which are baskets of stocks. So one share of a mutual fund means ownership in maybe 500 companies or more. So that's how we diversify at a very low cost. Now, we're going to start with not only mutual funds, but low-cost mutual funds. And that's very important. This will impact your financial returns to an unbelievable extent. And that's why I'm going to harp on it so much over the rest of tonight's webinar. And certain family of funds are known for low cost. Vanguard, Schwab are two. The amount that they charge for their mutual funds, particularly the index funds, which is what I'm going to be suggesting, is incredibly low when you compare it to the typical actively managed mutual funds. We're going to do it with automatic withdrawal because we want this to be user-friendly and time efficient. You know, most of you are going to be in school or working or starting families. You're going to be very, very busy. And that's why it was so important when I developed this strategy to make it user-friendly and time efficient. That's why automatic withdrawal had to be part of this system. So it's automatically withdrawn from a checking account on the specific instructions you give to your broker. And we're going to go up to 1,000 and up to 25,000 with low cost mutual funds, specifically index funds. So we'll show you how that works in just a bit. Once we hit 25,000, we're then going to move on to stocks. Now, let me say this. You don't have to move on to stocks. You could stay with mutual funds and make it very easy and time efficient. But by the time you're ready to move into stocks, you're going to be very familiar with the system. I'm going to show you how incredibly easy it's going to be to select the most appropriate stocks for this long-term strategy. And by selecting individual stocks, you're going to be able to get even higher returns than what we're talking about now. And we're going to use a screen at finviz.com. You're going to see it in action in just a minute. And once we buy those stocks, again, just let me reiterate now, we start when our portfolio reaches 25,000. So we could purchase 5 stocks and allocate $5,000 per security. Once we buy those 5 stocks, when do we sell them? Do we keep them forever? Do we ignore them? No, we're not going to do that. We're going to protect ourselves from share price decline by setting what are known as trailing stop loss orders. Very, very easy, also automated. We're going to discuss that. And then the final point here is that once a year, we rebalance our portfolio. Because at the end of the year, some stocks have done way better than others. So you may have one stock that has a lot more cash allocated to it than the others. So we're going to want to sell off some of those shares and allocate it to the ones that have a smaller position, so that if one stock turns against us, it won't impact our portfolio in a big way. So that's known as portfolio rebalancing. We do that once a year. Now, I want to talk to you about the difference between mutual funds and exchange traded funds, because that's always a big dilemma for a lot of people. Which way do I go, with a mutual fund or an exchange traded fund? Let me first tell you the difference. An exchange traded fund is a basket of stocks, as are mutual funds, but exchange traded funds trade like stocks. So you could, during the course of a day, take a look and see what the price of that ETF is and purchase it at that price throughout the day. Not so with mutual funds. Those prices are set at the end of the day. So let's say it's Tuesday afternoon at 2 o'clock. We go in, we buy shares of a particular mutual fund. We won't know the price that we got those shares for until the next day, till the market closes. After market close, the price is set. ETFs are traded on exchanges just like stocks. Mutual funds are redeemed by that particular fund, Vanguard, Schwab, and so on. There are certain tax benefits to exchange traded funds, whereas mutual funds have less control. Now, the way we're going to do it in this particular strategy, we're going to minimize tax liability by using index funds geared to a broad market benchmark like the S&P 500 or the total stock market. So there's going to be less trading and therefore less tax liability. Also, you can trade in a certain type of account where taxes are non-issues. Those are called sheltered accounts. Now, with ETFs, you could short ETFs and put limit orders. Limit orders mean you could say to your broker, I'll buy that if it hits this particular price. Can't do that with mutual funds. You can also short an ETF, which means you could sell it even if you don't own it by borrowing shares from your broker. You cannot do that, either one, with mutual funds. Now, when you buy an ETF, it's like buying a stock. There are trading commissions applicable. With mutual funds, particularly no-load funds, there are limited or no transaction fees. So that's an advantage of mutual funds. ETFs can be purchased by any broker, much more limited availability with mutual funds. Now, here's something that's general, but it's not going to apply to us. ETFs have lower expense ratios, lower costs associated with them in general than do mutual funds, which frequently have high sales loads. But we're only going to select mutual funds that have no sales loads and that have very low expense ratios. So we're going to be very selective. The days of high sales loads and expense ratios are gone, folks. It does not apply to us anymore. You could use margin with ETFs. That means you could borrow money from your broker to leverage better results, but you also can have leverage worse results. So it's a very risky strategy, which I don't advise for most retail investors. You cannot use margin with mutual funds. And back to tax a little bit, no tax impact from broker trading with ETFs. There's certain things that they could do to minimize tax issues. There may be capital gains distributions related to mutual funds. So there are certain tax advantages of ETFs over mutual funds, but I'm going to show you how to minimize all that. Okay, so why should we favor index funds? This is such an important point that I want you to really hone in on this fact. And I'm going to tell you some things that most of you probably don't know, and you'll probably be very surprised at. And for the students here, I would suggest you share this with your family. Index mutual funds, they can be purchased by automatic withdrawal in dollar amounts. That's one benefit of a mutual fund. Index funds have very low expense ratios. That's the key. The ones I'm going to show you have expense ratios under 1, way under 1. Whereas the average actively managed mutual fund can have expense ratios ranging from 1.5% to 2%. It's a huge difference. And over years and decades of investing, it's going to mean tens of thousands of dollars, maybe more. Index funds usually can be purchased with low or no commissions. All right. So again, we don't want to spend money. We just want to make money. And that's the basis of this strategy. These mutual funds can be purchased fractionally. So if you gear $100 a month and it's trading at $12 a share, you could buy 8.5 shares. It's allowed. So you can't do that with ETFs. Now, here's the key also. Index funds geared to a broad market index like the S&P 500 or the total stock market, in general, outperform actively managed funds big time. I would say the accepted percentage is somewhere between 75 and 85% of actively managed mutual funds underperform the overall market. And when I say actively managed, that means there's a manager that's sitting there deciding what stocks to buy and sell. When you have an index fund geared to the S&P 500 or the total stock market, a computer can do it because there are certain stocks within that benchmark that must be purchased based on the brochure that's stated regarding this particular index fund. And usually it's based on market capitalization, which means the size of the company. So larger companies have a bigger presence in the index fund. So a computer can do that. You don't need somebody racking their brains figuring out what stocks to buy and sell. And that's why the expenses are so much lower than that of an actively managed fund. So let me just review now. We're going to do automatic withdrawal of a low expense ratio, broad market index mutual fund, and we're going to purchase shares fractionally by investing 1/12 of 10% of our gross annual income. Now here's a screenshot I took right off the Schwab site, and let me just show you the two index funds that I show in my book. This is the S&P 500. You see the ticker symbol SWPPX, and here's the slight advantage over Vanguard up to $10,000, and then Vanguard has an advantage over Schwab after that. Here's an exercise I did a couple of months ago, and I just want to hammer this home so you could really see dramatically how index funds really beat up on actively managed funds. Every year, Kiplinger Advisors puts out a report they call the KIP 25. Now, the KIP 25 are the recommended mutual funds, no-load mutual funds that Kiplinger recommends. These are the funds they think are going to outperform over the next year. And that list you see on the extreme left. Way at the bottom, you see a ticker symbol for a broad market index fund from Vanguard, which is based on their S&P 500 admiral shares. That means you could purchase these with $10,000 or more. Now, over the one-year time frame since this recommendation came out, some of the KIP 25 did pretty good. This one here, the top one, TWEIX, was up 5%. Here's one that was up 4.5%. Here's one that was up 6%. The Admiral Fund of Vanguard was up 3%. But let's take a look at the other side of the coin. Some of them did really poorly. FMILX was down 11%. Here's one down another 11%, 9.5%. When the smoke clears and I averaged all of these up, if you had an equal position in each one of these, you had an average one-year return of minus 1.3%. These are the recommended stocks from Kiplinger Kiplinger advisors, and that was 4.3% less than just getting an income. That's a major big deal to outperform by 4.3% in a one-year time frame. So this goes to show you how difficult it is for actively managed funds to outperform the overall market. It's much simpler to stay with an index fund that has very low costs. So I told you that we're going to stay with that plan. If you think about it, all you have to do is put the instructions out to your broker with these index funds, and really you don't have to do anything after that except to fund your checking account, make sure the money is in there at the particular time of the month when you're going to remove 1/12 of 10% of your gross annual income. Now, I hope that most of you, if you're going to implement this plan, take advantage of the next part where when your portfolio hits 25,000 to move into stocks. Because if you move into elite performing stocks, you could take that 1.8 million and do much, much better than that. Now, in order to diversify properly, you're going to need 5 different stocks in 5 different industries, which means we're going to allocate about $5,000 per position. Now, this is important. I need you to keep your mutual fund account open, okay? Because what we're going to do is, once we purchase these shares, we're going to continue to feed our mutual fund account with 1/12 of 10% of our gross annual income. We're going to continue to build up our mutual fund account. So we purchase the shares, but we continue the automatic withdrawal from our checking account once a month into our mutual fund account. Every time our mutual fund account reaches $5,000, then we're going to purchase another $1,000 of each of our 5 stocks. And then as the account grows and grows and grows, we can purchase more than 5 positions. And that information is found in my book. You know, we don't have time to get into that, but I give you specific time frames when to expand the number of stocks in your portfolio. Okay, so we're going to have, at that point, we're going to have 2 brokerage accounts, one for our broad market index mutual funds, and then one for our stocks. And this is years down the road, folks. So once you start this strategy, you're not going to really be thinking about stocks until a couple of years down the road when you reach 25,000. Now, how do we know what stocks to select? Now, those of you who have worked with me over the years with options know that we have a 3-pronged approach to selecting stocks. It's the same with this long-term strategy, just slightly different analysis. We're going to do fundamental analysis, look at earnings and revenues. We're going to look at the price chart, but we're not going to actually have to build a price chart like we do with options. We're going to be able to put it right into our screener. And we're going to look at common sense principles, but these are going to be more descriptive in nature compared to some of the principles we look at for short-term option trading. All right, everything's going to be done simply by using the screener. Now, here's the site that I mentioned before, finviz.com. And the screen, you just click on screener. And what I want to show you now are the 3 categories that I just mentioned: the fundamental, the technical, and the descriptive. So every category, you don't have to use all of these, just the ones that I show you, has a drop down. And then you click on the particular parameter that you're interested in. For example, the market capitalization or the size of the company. We want to focus at least on mid-cap companies that have over 2 billion in market capitalization. And then there are fundamental screens, like we want our PEG ratio, which is the PE ratio divided by the growth, projected growth of the company, to be under 2. All these parameters are explained in my book. I suggest that you kind of understand what they're all about, but you actually don't have to see it here on the chart. And once you do that and you click on, you click on that you'd like to see the stocks, you're going to get a result like this, which shows you the top part of the stocks that were produced with those particular parameters. Now, the 5 that I selected are the ones that I highlighted in blue. So let me tell you some of the things that went into my decisions here. You notice on this sector, I kind of colorized some of the rows, and to show you that all the yellow ones, for example, were in the same industrial goods sector, and all of the green ones were in the same basic materials sector. Well, we don't want to have all the stocks from the same sector or overload with one particular sector. We want to have diversification. So when the smoke clears, what we did was we selected 5 from 5 different sectors here. And these are the prices on the far right side. So now we have 5 great performing stocks based on the parameters we put into the screener. And we're going to use 5 different stocks from 5 different sectors. You could do industry diversification as well. Sector diversification will give you a little broader diversification than will industry, but still very good on both. All right, so how many shares do we buy of each stock? How do we figure that out? Well, that's what we're going to go to on the next screen here. Since we have $25,000 available at this point in time, we're going to take each particular stock, we're going to look at the price per share, we're going to divide that into 5,000, and that's going to tell us how many shares we're going to purchase. You could see all the way over on the far right, that's how much cash we spent to purchase those shares, and the total came to $24,965. Just make sure that after you purchase these shares, there's enough cash left in your mutual fund account to keep that account open. Speak to your broker and say, what's the minimum amount of cash value that I need in that account to keep it open, and you'll just make sure that you do so. But that's how you determine which stocks to buy, how many shares to buy, and we're keeping in mind that we now have 2 accounts that we're keeping open. One is completely automated, and this one will be almost automated. So, ladies and gentlemen, we now own 5 stocks in 5 different sectors. How do we know when to sell them? Well, that part is going to be easy too, because we are going to use trailing stop loss orders. Let me give you an example of how this works, and let me tell you that it's also automated. Let's say we buy a stock at $20. Now, of course, we hope the stock price goes up, but it could go down. Now, when do we sell? Well, we're going to set a stop loss order at 10%. So we're instructing our broker, and that's just automated. When we execute the trade, part of the execution is to set up this stop loss order, but specifically trailing stop loss order, and I'll explain why in just a moment. Now, I'm going to set it at 10%. You may want to set it at 8% or 12%, but 10% is about where most people set a stop loss order up, which is telling our broker, hey, listen, I'm buying the stock at 20, but if it goes below 18, I want you to sell it. So that means, we're losing money, but we're not going to lose a lot of money. And that's how a stop loss order works. But what if the price goes up? Let's say it goes all the way up to 30 from 20. Well, then a trailing stop loss order of 18 is not appropriate. And that's why we use trailing stop, not just stop loss orders, because it moves up with the price of the stock. So for example, if the price of the stock is now at 30, 10% of that is 3. So our stop loss order is now 27. It's not 18 anymore. It moves up. We're not capping the upside, and we're not creating a stop loss order that's so far away from the current market value that we won't lock in all of that juicy profit we just got when the stock went from 20 up to 30. If the price moves to 35, 10% of that is 350. A new trailing stop loss order is now set at 3150. So a ceiling is never capped. That's automated, ladies and gentlemen. So you don't have to go in and look at it and keep setting a new stop loss order. As time goes on, it'll automatically change. This is taken also off the Schwab site, and you could see here where that long green arrow is. That's where you check the box for trailing stop exit, and you set it at 10% or whatever number you decide to set it at. And that means that as the stock price goes up, so will your trailing stop loss order also go up. Okay. Now, I told you that you need $1,000 to open a brokerage account. What kind of account should you open? Well, you have different kinds of accounts. Let's start with the basic full service versus discount. Full service means that you're asking the broker to provide you with advice, and in return, he's going to ask you to provide him with money. And remember, we're here to make money, not to spend money. So we need to educate ourselves to the point where we could use an online discount broker, the kind that I've showed you so far, which means that if there are trading commissions, they're going to be very, very, very low. And that's very important. So we're not going to depend on the broker to tell us what to do. We're going to learn how to do it ourselves. Now, there are also cash accounts, which means that everything we buy, we can afford to buy because we have the money in the account. That's the kind that I like. There are margin accounts, which allows you to borrow money from your broker. And that perhaps is for sophisticated investors that have a higher risk tolerance than most retail investors. And I don't believe it's good for long-term retirement plans. And then there are option accounts, which is what I use for most of my investing, but you don't need that for this long-term investment plan unless towards the end you want to incorporate options. We'll briefly touch upon that at the very end of today's webinar. We have sheltered accounts and there are non-sheltered accounts. This is a tax issue. Sheltered accounts means you don't pay tax or you defer tax until and when you take the money out. IRA accounts can be Roth, which is you don't get a tax benefit when you put the money in, but when you take it out, you don't pay any tax on the money you put in or the profits that money earned for you. And traditional, well, you do get a tax benefit when you put the money in and you defer the taxes until you withdraw. And at that point, theoretically, you're in a lower tax bracket. I'm not a tax expert, so I can't give advice, but I can tell you that most tax experts say the younger you are, the more appropriate a Roth is, but check with your tax advisor on that. Here is a graphic of the entire strategy that we just went through. The yellow bar at the bottom is the $1,000 that you're going to save up to open a broker account. The brown bar here represents the investment in the low expense ratio broad market index funds that you're going to automate. And this blue area in here, for those of you that move to stocks, is what's going to take your portfolio from 25,000 up to 1.8 million using the screener and trailing stop loss orders. So there's a graphic representation of the entire procedure. Here's a review of our strategy rules. We're going to write down our goal, $1.8 million by age 58, adjust it according to your specific situation. We're going to start with low expense ratio broad market index funds. Schwab and Vanguard are two examples. There are others. Tell your broker to reinvest all dividends. We're compounding our money. We're dollar cost averaging in 1/12 of 10% of our gross annual income, and we're automating it. All you have to do is give those initial instructions, and you could forget about it from there. Just make sure you fund your checking account. We're going to move to stocks. Many of you can move to stocks when you reach 25,000. We're going to use online screeners and trailing stop loss orders to automate most of the process. So it's very user-friendly based on historical data. And that's how you're going to accomplish your goal, and you will accomplish your goal. Now, Barry Bergman was good enough to make this flow chart, which describes everything that we just talked about, starting with opening your account, the broad market index funds, 1/12 of 10% of your gross annual income. At 25,000, you move to stocks, use the online screening tools, manage your account with the trailing stop loss orders, rebalance once a year. Then if you really want to get fancy, and this is something you won't have to think of for a long, long time, but we teach strategies where you can really increase your returns even to higher extents than the impressive returns I've talked about. You know that I'm all about covered call writing and selling cash secured puts. or using both strategies, put, call, put. You can add things like a protective collar. You don't have to worry about this now. Many of you are familiar with options, so probably know what I'm talking about. And then there are other stock substitution strategies like the poor man's covered call, which is going to be a webinar coming up pretty soon. A lot of you have been asking me about that. Now, for premium members, you could get this flow chart by logging into the member site, looking on the right-hand side that says resources and downloads, and scroll down to flowchart F, long-term investing. Those of you who are not premium members, if you send an email to me or Barry, we'll be happy to send you a copy of this flowchart. I'll give you the email addresses at the end of the presentation. Now, I promised you some questions. These are related mostly to options, and we selected 5 questions from our members. The first one is from Dan, and Dan asks, is it better to sell puts rather than covered calls because it's one less commission? Well, here's what Dan means. When you sell a covered call, you buy a stock, and then you sell the call. So buy stock, commission 1, sell the call, commission 2. When you sell a put, you just put the cash into your account, you sell a put, that's commission 1. But here's the takeaway. Never, ever, ever select a strategy based on commissions. You know, years ago when commissions were 50 a trade, 100 a trade, even 200 a trade, you know, maybe a case could be made. But nowadays, when commissions are $8, $6, interactive, $1, you know, commissions never should play a role in which strategy we select. So let me give you a couple of counter arguments to the one that Dan stated, which is pretty common. You hear it a lot. People say that put selling is better because there's one less commission. Let me give a couple of counter arguments to that. If we write a covered call, we have an opportunity for 2 income streams. When you sell a put, your maximum gain is the put premium, period, end of story. Let's assume for a moment we sell an out-of-the-money call. We make money on the sale of the call, and we have potential for share appreciation. Let me give you a specific example. Let's say a stock is trading at $47.50, right? We could buy the stock at $47.50, commission 1, sell the out-of-the-money call, commission 2. But we have an opportunity to make even more than the option premium. Now, if we sold the 45 put, which is out of the money for puts, by the same amount, by $250, just like the 50 call is out of the money by $250, let's assume the premium for both is $1. The return on the put side is slightly more because the broker will allow you to put the put premium towards the amount of cash you need to set aside, but about the same, 2.3%, 2.2%. But have a look at this, folks. With the covered call, you have an opportunity to make another $2.50 per share. The price of the stock goes from $47.50 up to the 50 strike. So you have an opportunity with the covered call to make $3.50, not $1, $3.50, which is a 7.4% 1-month return, which makes the 2.3% put premium look pretty scrawny. And now you would say to yourself, wow, that other commission of $875 was sure money well spent because I made another $250. Now, proponents of put selling might say, well, you know what? How about if we sell an in-the-money put, and that will generate even more cash than the out-of-the-money put? So there. Well, that makes no sense, because if you're going to use this strategy just to have one commission, then your goal is not to have those shares put to you. And if you sell an in-the-money put, that's increasing the chances of those shares being put to us. And if they are, boom, there's your second commission. And if that strike remains in the money near expiration and you don't want the shares put to you, then you have to buy back that option. Boom, commission number 2 anyway. So do not use puts, do not use commission as a reason to favor put selling over call selling. Do not. Now, I would consider puts as a good strategy unto itself in bear markets, or when using the combination strategy called the PCP strategy, where you use both puts and calls, but not because of one less commission. That makes no sense. Stay away. Mary Ann asks, will we be affected by the new Department of Labor rules this April? The very, very short answer is no, because we use online discount brokers. Now, the Department of Labor rules apply only to retirement accounts, and they really cracking down on the brokers because a lot of brokers are taking advantage of retail investors and charging them way, way too much, and that's affecting our bottom line when we're ready for retirement. Here are the changes that I think, and I could be wrong, but I'm probably right about most of these. You could see coming up in April and then again in January of 2018 when the two steps of these changes are going to be made. I believe that commission-based retirement accounts and full-service brokers are going to be a thing of the past, and they're going to be based just on fees. All right, and that's because brokers are going to have a hard time justify charging a lot of commissions. I think smaller full-service brokerage accounts, you may have a small retirement account, you may be dropped if you're using a full-service broker. They may ask you to move on to an online broker or a robo-advisor, one of those automated advisors, or to larger firms. I think smaller broker-dealers may pursue mergers with other companies so they can afford all of these new rules and regulations. We'll see what happens, but I do believe that will happen. Annuity products, goodbye annuity products, they're gone, in my opinion, because the sales, they're such high commission products. So I think brokers are going to be too afraid to deal with the Department of Labor if they're selling annuity products with very high fees. Robo-advisors, those are automated advisors. They provide digital advice. You know, they put you into certain categories, mostly using exchange-traded funds. Some of the more popular ones are Betterment, Wealthfront, Personal Capital. They're going to benefit. I think finance professionals are going to move away from mutual funds that have sales loads. We talked about that before. High expense ratios, goodbye high expense ratios. And funds that carry what are known as 12B1 fees. Probably most of you never heard of that. It's snuck into the prospectus in small print at the bottom someplace. Those are advertising fees they charge in a lot of funds that could be up to 1%. That's a lot. And I don't think you're going to see any funds with 12B1 fees. So that'll be helpful to retail investors that are using full service brokers. Exchange traded funds are going to benefit because they're generally cheaper, and I think they're going to be beneficiaries. They also are the go-to product for the robo-advisor. So I think ETFs are going to be big beneficiaries, and as a result, I believe that a lot of brokers are going to lower their fees trying to get that ETF business. And finally, I think there's going to be a growth of a new industry of lawyers that are experts in this field. Now, this is my take. I can't guarantee it, but I feel pretty certain based on everything I've read and people that I've spoken to. Mario asks, what's the best time to execute our covered call trades? Well, the best time to execute a trade is the first couple of days of a contract. Let me just draw a little picture here with one of my little toys. Theta is the time value erosion of an option. Every day that passes, that option is worth less. It's kind of like buying a car and pulling it out of a parking lot, and every day that car is worth less. So here's how it works for a 1 month option. The first week or so, it starts going down slowly. The second week, it starts going down a little bit more. The third week, a little faster. And the fourth week, it falls off a cliff. So if we want to sell our option, let's say over here, Mario, it's like $2. Over here, assuming time value erosion only and nothing else affects the price of the option, here it might be $1.95, here it might be $1.83, here it may be 99 cents, here it could be 60 cents, here it could be 2 pennies. So where do we want to sell the option? We want to sell it here at the beginning of the contract. And then during the course of the contract, the time value will go down, but we already made our money when we sold it up here. So the answer is the first couple of days of a monthly contract. I like to sell my options between 11 a.m. and 3 p.m. because we're going to avoid the computerized institutional trading that goes on by the big boys. And I mean the mutual funds, the hedge funds, the banks, the insurance companies. So there's less volatility during these hours. So that's my sweet spot. You know that we buy back an option using the 20%, 10% guidelines. That's in my covered call books. We can automate that. So let's say we sold an option for $2. We can immediately put in a limit order to buy it back at 40 cents in the first half of the contract, and just change it to 20 cents in the second half of the contract. So that can be automated. As far as if the price goes way up and using the mid-contract unwind exit strategy, those of you who are doing covered call writing, that's early to mid-contract. You just have to keep an eye on stocks that are going way, way up. And finally, rolling options, which means buying back the current month and selling the next month. I like to do that as close to 4 p.m. Eastern time on expiration Friday as possible, because there's theta or time value benefit to that. Let me go back to my beautiful diagram up here and show you why. Okay. On the near month option, the one that's about to expire, remember the time value is all the way down here. It's a couple of pennies. But what about on the next month? So we're buying back the near month and selling the next month. Well, that time value is eroding very slowly. So if we keep waiting and waiting and waiting on the near month, the time value will be going down dramatically. Whereas the far month, the time value is hardly going down at all. So the net benefit is to our advantage to wait as close to 4 o'clock on the third Friday of the month, that's Eastern time, as possible. But don't start like 10 to 4. You know, you might have a glitch in the trading platform or something. I usually start rolling options about 2 o'clock on expiration Friday. But if you're not going to be around and you have to do it on Thursday or Wednesday, it's no big deal. It's just a little bit better to wait close to expiration Friday, as close to 4 o'clock as possible. Larry asks, for a covered call that's in the money, when's the best time to roll out and up? Do I roll out when there's no time value decay left? Hint, yes. Or do I roll when the option is a certain percentage in the money? Well, we kind of just addressed that. So we look for theta decay is logarithmic. It's that diagram that I showed you before. You know, some people think theta decay is linear. It's not. It's logarithmic. So it starts off slowly and then drops off a cliff. So each month the time value erodes faster than the far month time value. So it pays to wait to 4 o'clock. Now, the intrinsic value component, I want you to measure time value only. That's the key I want to give you with this particular question here. Time value is the only thing that's important. The intrinsic value we get compensated for. So let's say, let's set up a hypothetical here. We sold the 50 call and the stock is 52 as expiration is approaching, right? So what's it going to cost us to buy back that near month option? Well, there's $2 of intrinsic value because the 50 strike is $2 in the money. Time value, remember, is down here. It's only pennies. Let's say it cost us $2.05, right? Now, if we roll out and up to the 55 strike, now what are our shares worth? Well, with the 50 strike in place, our shares can only be worth $50. But if we buy back that 50 call for $2.05, our shares are now worth market value, 52. So the $2 we lose here on buying back the option, we gain here in share appreciation, right? So that compensates us. That means the cost to close and roll the option is 5 cents or $5 per contract. What if we roll up? This is really getting tricky, Larry. I'm sorry about this, but I like math, so I'm going to throw this in anyway. What if we roll out and up to the 51 strike? Well, now our shares aren't worth 50. They're worth 51. So of the 205, we're only getting back $1. However, the new premium we sell with the 51 strike is going to have a time value component plus an intrinsic value of $1. So the $2 is going to be compensated for. The takeaway here, Larry, wait as close as possible to 4 p.m. Eastern time on the third Friday of the month and calculate time value only. Don't worry about the intrinsic value. The Ellman calculator will do this for you. Look at the What Now tab and it'll do all the math. You don't have to worry about it. And finally, here's a question I got right before we went live, about an hour or two, from Joe and Cindy, and congratulations, Joe, for bringing Cindy on board. Nothing like family affairs with investing. I commend you for that, both of you. Could you tell us 2 or 3 market conditions, not earnings announcements, that would keep you from selling a covered call for the current month? Well, I'm fully invested almost all the time, and I'm not sure if you mean general or for a specific stock, but in general, the only time I'm out of covered call writing are for catastrophic events, like I was 50% in cash for Brexit, and I went into 100% cash before the election night. Go figure, Trump wins and the stock market survives. So I thought, based on all the information we had up to that point, that if Trump won, the market would go down. But I was wrong, and so was just about everybody else. But you just play it safe. Otherwise, I'm in the market. I am rarely in cash. Now, if you're talking about individual securities, when would I avoid a particular stock for selling a covered call? Here are some reasons why. You asked for 2 or 3. I gave you 3. If the returns on that particular stock does not meet my goal. And normally I target 2 to 4% a month for my initial return. I also will avoid a security if the returns are too high. Let's say I like stock XYZ and it's trading at 48. I look at the 50 call and the 1 month return is 10%. Well, that tells me that the implied volatility of that stock is extremely high, which makes the trade extremely risky, so I stay away. My sweet spot is 2 to 4% a month. In a bull market, I'll go up as high as 6%, but I don't want anything more than that, because that will mean that it's a risky trade. And also, I might avoid a particular stock if there are diversification issues. Let's say my portfolio already has a couple of computer hardware stocks, and now I'm looking at another one and I go, gee, it's a great stock, it's on the premium list, it gives a good return, but it's not appropriate for my portfolio because I already have a couple of computer hardware stocks, therefore I'll stay away from it. So in bear and volatile markets, when a lot of people head for the hills, I manage my positions by staying fully invested in most situations except those catastrophic ones I mentioned before, by the way I select a stock, by the way I select an option. In the money options is a way to go. I might sell an out-of-the-money put before I write a covered call. There are so many different things, position management techniques you could do to mitigate through those kind of markets. And don't throw your hands up when the markets become a little more challenging. I kind of look at it like, it's pretty easy to drive a car when the weather is clear and dry. But when it's raining, we could still drive a car if we go slowly and put our wipers on and obey all the traffic signals and so on. So there are ways of mitigating through more challenging environments. I just want to mention to you that I've been invited to a panel discussion put on by the Options Industry Council coming up this Tuesday at 1:30 p.m. There I am on their site. The link to register is on the latest blog or on the events portion of our website. Just go to the blog site, look for the events link, or the last blog article has the link too. It's free, and if you register and you can't be there for the live event, they will send you a recording, a link to the recording. And it's a panel discussion. I'm the go-to guy for them on covered call writing. There'll be other experts in on the panel. I'm not sure which ones or what they're going to talk about, but usually they're very good and very educational. This presentation was based on my book, Stock Investing for Students. We've increased our supply because a lot of people get them for the holidays. If anybody decides to purchase the book or anything else on our website, just want to remind you that we have a holiday code, a holiday promo code, Holiday10. So when you put that in, you get a 10% discount at checkout. If you're a premium member, enter the store through the premium site, and you'll get your 10% member discount, plus use this, so you'll end up with a 20% discount on any and all items you order from the member store. So that pretty much takes care of the presentation. As I turn around and look at the clock, I've gone about 5 minutes over. So pretty good for the amount of material that I had to disseminate tonight and the 5 questions. I just want to remind you that if there were any questions unanswered, you can email me at alan@thebluecollarinvestor.com or email barry@thebluecollarinvestor.com with any questions, or if you want a copy of that flow chart or anything else. We do get to all of our emails. So I want to thank you all very much for attending. I want to thank Barry and Darius for assisting me with this webinar. It will be recorded and placed on the member site probably within a couple of days. And I hope that you enjoyed this presentation. We have another one coming up in 2 months, and that one will probably be the poor man's covered call. That's the one I'm planning on using, so we'll send out notifications of that one as well. Thank you all very, very much for attending, and as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.